For our final panel of the evening, we're going to explore the future of alternative investments, which is happening right now. And we have 4 industry leaders here to share their perspective on how technology is enabling an understanding of and access to increasingly important asset classes within the evolving wealth management space. So I'd like to bring out our moderator. We have Matt Brown, the CEO of CAIS. And our panelists, we have Pierre Caramazza, the head of U.S. Product and Specialty Sales at Franklin Templeton, Howard Nifoussi, U.S. head of Wealth Management at Apollo Global Management, Adam Green, CEO of YieldX, and Rishi Khanna, CEO of Stocktwits.
Hey. Hello, everybody. Are we the last event between cocktail hour? So we're going to keep this really exciting. My name is Matt Brown. I'm the founder and CEO of CAIS. Couldn't be happier to be hosting this panel on a topic that I know a bit about, which is the future of alternative investments, democratizing access. This is a really exciting time to be in this space. There's just so much going on. And I couldn't be happier to have really 4 great industry leaders in all slightly different areas, actually, to have this great conversation this afternoon. So I'm going to ask each of the panelists to just introduce yourself, quick word on your business and your role, and then we'll jump in. We'll start with you.
Pierre Caramazza. I work for Franklin Templeton. I run our product and specialty sales in the U.S., and I'm the representative of sort of the old line asset management teams looking to participate in alts.
Hi, I'm Adam Green, CEO and co-founder of YieldX, and we built the first digital end-to-end infrastructure for global fixed income investing.
Good afternoon, everyone. Howard Nifoussi. I am the head of U.S. Wealth Management Solutions for Apollo, and I'm probably the oldest of the old guards in terms of I've only really done one thing in my career, which is distribute alternative investment products to high net worth investors through financial advisors. So bringing it to the future with friends like Matt here is actually quite exciting. So happy to be here, and thanks for the time.
Hey everyone, Rishi Khanna, CEO of Stocktwits. Stocktwits is one of the largest social platforms for retail investors and traders, and it's been around 6 million plus users. And by background, though, I spent about 15 plus years in alternatives prior to becoming CEO of Stocktwits. So.
Great. Well, gents, welcome. Let's kick off here. I'd like to start off with kind of a larger question, which has a lot of different components to it. And Howard, I'm going to ask you to lead in, but we keep hearing about the rise of alternatives. Alternatives seem to be on the top of the tongue of everyone. What's happening? What's going on? Why is everyone talking about this?
Now look, it's a great question. And I've been asking this question for 20-something years, which is, when is it going to finally take off? And I hung around the hoop long enough that it actually is. But for all the years that many of us have been out there talking to the financial advisor community, you've looked at asset allocation models at the firm levels, which have called for 10, 15, 20% allocation to anything that's not long-only stock and bonds, right, or alternatives. Yet for the last 20 years, it's just crept up, at least in the world of high net worth investors, from 1 to 2 to maybe 3% of their total portfolios. Which represents, I don't know, somewhere around $2.5 trillion of assets, which is a fraction of the 15 trillion or so of assets that are actually in alternatives overall, mostly from institutions. So I think what's going on is it's probably an overused phrase, but the democratization of alternative investments is happening, and now it's happening fast, mostly with the advent of technologies. You're at the forefront of that are making these asset classes easier to access, easier to understand. And you combine that with firms like Apollo really putting the heft of resources behind supporting the advisor and client community. There's finally the scale that people have been talking about.
But let's go back to that demand side quickly, because you said the advisor, the 60-40 underallocated. That doesn't mean that they want it. It just means they're underallocated to it. What's driving the renewed interest in the demand of the buy side?
Look, I think there is a commitment on behalf of firms like Apollo and other firms to finally do everything they need to do to educate the financial advisor community first and foremost. The biggest challenge I think individual investors have had historically with allocating to the space is just the nuances around the asset class. The fact that if I wanted to invest in a private equity fund just 2 years ago, not even 10 years ago, I would get a 350-page document delivered to my doorstep that I would have to go through page by page and then actually do this thing which is called sign the document with a pen, send it back, and then have 50 iterations back and forth because I missed my signature on page 14A, whatever it was. That's number one. That's changed, right? You've changed that.
We have, but hold on to that thought. Before we go
Yeah.
into the technology and the automation side, and that's a huge piece of this,
Yep.
just zeroing in back on this demand. And Pierre, let me talk to you. You guys are a traditional asset management firm. You've been acquiring a lot of businesses I want to talk about later. But what's driving the demand? Is the 60-40 portfolio dead? Is the financial advisor just exhausted?
I think that's part of it, but I don't know if it's the advisor being exhausted as much as I think it's just the dynamics of the market have changed. So if you think about public companies versus private companies, literally 5 years ago, right? You kind of looked at the marketplace today. Like the number of private companies has increased by almost eightfold, and you look at the number of public companies, and over the last few years, it's actually shrunk by about half, right? So now you've got this big turnaround between the number of public companies and number of private companies. Likewise, when you look at when private companies sort of IPO, going back, call it 96 through 2005-ish, right? You had it going at about a 3 to 5 year pace. Since 2016, you look at the average, it's about 10 years. And so what we're seeing in the equity space is effectively, 2 times the performance of private equity versus public equity. It's lost. So if you're a public-only manager or a public-only investor, you're giving that up. And I think you're seeing that in private credit too, less so on a performance basis, but certainly on a risk-adjusted performance basis. So I think that fundamentally has driven some of that change.
Would you also say that, and just pulling off what Howard just says, that asset managers too, for the first time, are really creating the right investment vehicles and structures that are at least being received well in the advisor community? That's
a fantastic line. And I used to tell people, democratization of alts happened like 15, 20 years ago, right? Everyone had the access to it. This is like 2.0, where now all of a sudden you actually have institutional quality investors coming in, right? So the investment management team has changed. The second thing is the vehicles have changed, where I think if you went back, then the incentives were set up for sort of very, very high fee transactional business, which may not necessarily have been always in the best interest of clients. And you now, today, it's a very, very different marketplace too. And I think that's really been a fundamental change. And that's when, we've looked at it, and we've typically always kind of serviced what we'd call middle America as well. And we wanted to get to a point where we felt really good about, investing in the space and providing that to our clients.
Yeah. Adam or Rishi, I think a lot about technology's impact on just democratization of all things in the community, whether it's to the financial advisor or down to the high net worth investor. Can you kind of comment on kind of what impact you've seen over the last 5 or 10 years, and either one of you can lead off with that?
Yeah, so we're seeing a couple things happen simultaneously in terms of secular trends. Number one is the trend of personalization at scale. And so whether it's in the way that people are investing, the way that they're thinking about their portfolios, or any other industry for that matter, we're seeing the power of the individual dictate the demand of products from the market. And so where the trend used to be that large asset managers would come together, they'd create products, and they would push them down to the distribution channels, we're now seeing that in many cases, people are pulling from the demand based on data, based on real-time demand that they're seeing from whether it be advisors, their wealth managers, the market generally, and then using technology to better sort of in real time create products and solutions. And therefore you have different types of wrappers and products that are coming out that help create more efficient structures for alternatives. And I think it also begs the question, which we've talked about a little bit before, Matt, of what is an alt, right? There's different asset classes that sort of get bucketed into this category, but it really is a large sort of definition when it comes down to it. And
can you give us your definition?
Well, obviously the simple definition would be anything that's not part of the 60-40 bucket, right? But I think that comes down to, and that's another thing we're seeing. We have a very unique position at YieldX because we work with some of the world's largest asset managers, wealth managers, broker dealers, and we're seeing the position level data on tens of thousands of portfolios on a daily basis. So we see the impact of what the wealth managers and investors are doing on behalf of their clients and customers. And there's an insatiable appetite for something other than the norm.
Yep.
So I know that was a sort of a failed
No, I think
punt.
you're spot on with that. Rishi, I don't know, do you want to?
Yeah, no, and I think so. To build on that, right? There's, I think over time, right, investing is about information asymmetry, right? And information asymmetry and the access to information and data, which we were talking about even just a few minutes ago, has contracted in how long that information is reserved for the hedge funds or whatnot of the world. But now the accessibility of that to retail in the forms of information, in the forms of tools and data, is opening up a larger investing universe than just equities, which traditionally had been equities or options, or maybe if you were crazy, you were playing in bonds and stuff too as a retail investor. But now you have crypto, but you have this expanding universe of alternatives that are being fractionalized and made accessible in the same way they're being made accessible to the private wealth and financial advisory community. They will become fully accessible, and you'll have the information and data just as fast and make it just as available, so I can trade right on some retail platform and diversify my portfolio beyond the 60-40, right? And also, if you look at the next generation of retail, and our platform is 45% millennial, their interest in things outside of equities is much greater than traditional generations, right? But I remember in the 80s growing up, like helping my dad with his stock portfolio. But today it's not just stocks; it's collectibles, it's alternatives like real estate, yield-producing products, artwork. You can get any of these, and you can on these fractionalized platforms and other types of platforms. And it's pretty simple now, right? And so it's about information and unlocking that information to be able to make those investing decisions.
Yeah. Howard, you were talking about the streamlining or automation, that 200-page document. Now it's a fillable PDF or auto-populated. Tell us how much of an impact that has just on smoothing the pipe of execution.
Well, the last conversation, I think, leads right into this, because when we used to think about alternative investments, or when investors thought about alternative investments, they just thought about a vehicle that was locked up, that had terrible tax reporting that would go on for longer than many of their lives would continue to go on, and all the horrible stuff associated with being an investor in a private fund. But at the end of the day, that was just a poor structure, right? Or a challenging structure. I always talked about alternative investments as really just being anything that's not long only stock and bonds. And to your point, it could be NFTs or private equity or private ownership of companies or some private credit. But at the end of the day, it's just really anything that's not long only stock and bonds. So to your point, the technology that's come out to just get rid of many of those challenges that have withheld the advisor community and clients from actually investing in alternatives makes it just another asset class and not something that they view as a pain in the ass from a paperwork perspective. So that to me has been the biggest sea change. And now it's all about what's your investment acumen, which is, I think, for many of us who are the old school asset managers are happy to compete on.
Yeah, I also think piggybacking off what Howard said, if you go back to the sort of origin of these assets, right, a stock, a bond, right, technology is breaking down barriers of what these things are that sort of contain them in that bucket. So, I forget who said it initially, but the analytics, right, the ability to look at all these data points across different types of core underlying assets, right, a stock, a collectible, a piece of real estate. Now you have technology that can move so quickly to create this apples to apples comparison. So, we're all in some way, shape, or form risk managers here. And if you can have a common risk parameter across all these different types of assets, then at the end of the day, you're just looking for the right return to risk ratio, then it doesn't really matter what it is, because I'm not giving you a bond certificate anymore, right? It's all digitized, it's all fractionizable, and you have these distribution channels that create the access to the democratization that's happening as we see it.
By the way, I don't want to get over my skis here because I certainly shouldn't be talking. I mean, you said you'd punch me if I said blockchain, so I won't. But
Rishi was the one that broke it first.
but
We had a pact
Oh,
for
I did.
blockchain.
but tokenization, fractionalization, something I hear about a lot. I mean, I finally, our CEO, Mark Rowan, actually said it in the conversation where I finally understood it. So I'd be curious as to your view, which was, last year we did a massive $5 billion levered buyout of Yahoo from Verizon, right? And clearly that's a brand and a franchise that the individual investors, especially given what you said, Pierre, about lack of investable companies that are public today, would have been very, very attractive to a much broader audience than those who are just our good old-fashioned LPs in our private funds. And he was talking about this fractionalization, this tokenization, and being able to just carve out at $5, $10, $15, $20,000 slices through our distribution partners at major banks and wirehouses and others. It's just fascinating what's going on. And I mean, I feel like I'm learning about that every day.
You know what I think is going to be the testament to success of this sort of second generation of democratization of vaults? Because I think everything we're talking about right now is exactly what's allowing people to get there and to invest in it. And I think the next two tests are, first of all, you kind of hit on this sort of, but the performance of it, right? Which is, is a 60-40 dead? Well, it depends on when you started, because now all of a sudden, if I'm looking at my portfolio at the beginning of the year, I kind of wish I had a whole bunch of risk-off assets. And I think people always look at that piece of it. And I think when you start thinking about those alternative assets, it's great to have them tokenized, it's great to have them accessible, but what's the value they give me, right? Whether it's risk-adjusted, whether it's non-correlated, whether it's just straight performance, what is that thing? The second part of it, and this is whether it's a technology tool or an advisor or something else, is who's going to curate this? And so as you get this sort of frictionless environment, you also get that sort of mass information overload, right? Which I think is what most people probably experience when you get onto Amazon, right? And you're like, oh, I'd like to buy, shoes. And now all of a sudden, I don't have a selection of shoes. I have 500,000 shoes. And I'm trying to figure out literally, how I do this and how I size them differently. And so that curation piece of it's going to become really important. And I think our view on that has been that we need to be participating in it. We need to figure out how to do these vehicles, but we also need to be able to bring to investors, whether it's the advisors or people, education and some level of curation and some level of guidance of how to assess this, how to be educated about it, and how to make those choices.
Yeah, the curation piece is really huge because nobody needs another 60-40 model, right? I mean, if you look at the model marketplaces that are out there, and we're bringing to market a next generation model marketplace that does exactly that. It's curated based on machine learning and AI and content based on what's already in your portfolio, and therefore what will you likely want. And that really is the next generation of how technology can apply to the personalization of what we're seeing. There's also a huge aspect of disintermediation that technology is able to facilitate as you think through the tokenization and fractionalization and a lot of other Asians. I'm going to stop saying that. But I think it's really interesting to think about what could happen 1, 2, 5 years from now when large corporate issuers are working with technology platforms. What happens to the whole investment banking and all the intermediaries that help get these big securities to market, and where does that the economic benefit accrete to? It ultimately will go down to the end user, to the that's democratization.
Well, when you say end user, the first thing I think about is end user protection, and that takes me straight to the SEC. You have, forever, at least when I was growing up in the industry, the SEC's view on alternative investments, private equity, hedge funds, real estate, private credit, venture, you name the category, it was, you better be rich enough to lose a lot of money because don't come crying to us. That was just the general stance. So they put these very high barriers up. You have to be worth $5 million or $2 million or $1 million. And that prevented a lot of people from actually getting the access to these products. But I think the SEC, and correct me if I'm wrong, isn't the SEC kind of loosening their position on this now and kind of almost getting a little more on side of the modern thinking of, hey, wait a second, maybe actually that's preventing people from getting access, and we should actually open that up and create new lanes. I'll give an example. A friend of mine, she's extremely talented, went to business school, decided to work for a nonprofit. Brilliant, can analyze any investment, but she can't actually legally invest in Blackstone's real estate fund because her net worth isn't high enough. But the same side, you have, a gentleman selling maybe a a traditional business who has no investment background whatsoever, but yet because he has a net worth, he can invest. There's something wrong there. And I think the SEC is finally waking up and creating lanes based on licenses, based on accreditation, based on education. Do you see that as well happening?
Yeah, no, look, that's a huge sea change that's taking place in our industry, and that is certainly going to be some wind at our backs in terms of finally taking that 1% to 2% allocation in the world of wealth and high net worth investors to a level that's actually meaningful for their portfolio. I mean, the reality is there's a reason why institutions have historically outperformed individual investors from an investment perspective, and it's because of the ability to have a whole host of diversified assets in their portfolio. So that was a massive, massive hindrance, and certainly something that we're seeing change today. What that does, however, I think, and Pierre, I'm looking at you because you're in the same boat as I am, brings the onus right back on us, right? Because now it's all about what happens when one of those alternative investment strategies doesn't perform or actually performs really poorly. And then it's all going to be around what did you do to educate the advisors? What did you do to give the protections to the end client so that you were laying out all the good, the bad, the ugly to give them the opportunity to really understand what they were investing in? And that's the biggest thing that we're going to have to focus on as an industry.
You're right on it, Howard. I'm going to open it up. Let's just summarize the opportunity, and then I want to go to the risks real quick.
Yeah.
So we have a multi-trillion-dollar pool of capital, U.S. wealth management, $20 to $25 trillion, on average allocating to alternative investments broadly, depending on the subset within that 25, anywhere from 0 to 1% to maybe 8 to 9%. You have family offices and institutions allocating to alternative investments broadly between 30 and 50%. Okay. Disappointment with the 60-40 portfolio, not able to ride out uncertain times. They want to, get volatility lower, create new opportunity. Here comes alternatives. Okay, so we know the demand story. You have asset managers, clever ones, Apollo, Franklin Templeton, Blackstone, KKR, designing investment products specifically for the first time to meet the unique needs of wealth management. So it's no longer square peg in a round hole. It's the suit fits, okay? Demand meets supply. Then you have technology. Let's just remove all the pain.
Yep.
Companies like CAIS, our platform, let's just make this easy for the first time. And then you have the government actually supporting it. That all sounds really good if you're in the alternative investment business. But who is responsible for educating the RIA, the financial advisor, or the end investor? Where does that responsibility start and stop? And who's preventing, especially in the B2C land, gamification and misleading ways of selling?
Well, so a couple, just, on the who's educating, I mean, once you introduce supply, once you have, the frictionless liquidity in the supply, why does it look any different than equities? You can lose a shit ton in equities as well, right, if you don't do it right. So, I think on that front, that's where
The SEC would say because they're not registered.
No, and I'm with you, and I have strong opinions on accreditation. I'm glad that they're coming to their senses finally on that, because that model.
Well, share your view on that.
No, I mean, I thought accreditation was, the spirit of it was probably right, whenever it came about in terms of, hey, we got to protect from things that we're not requiring all the same disclosures maybe on. But what you did as a result of that, and especially in the last 20 years where a lot of the returns moved to these private markets, moved to whether it's, private equity, venture capital, or other markets outside of just regular stocks, you prevented regular people that are smart, investors that can make good decisions from participating in the wealth creation engine, right? And the only wealth creation engine, one of the very few we have left in the U.S. because of the way our tax systems are designed and stuff, is assets and investing in assets. And so, we talk about democratization finance and wanting people to be able to, build wealth and whatnot, but you have to let them actually into the system before they can benefit from the system, right? And so I think accreditation has been a big hindrance over the last 15 years, since 2008, when interest rates go to zero, asset values rise a lot, and who doesn't participate in that? People that can't own assets.
I also think that the sort of evolution of the large asset managers into the mainstream has helped change the SEC's views on whether or not the average person should have access to these products. Because before sort of the last generation or so, where some of these, especially in the private equity and hedge fund space, it was this elusive sort of group of clouded investment vehicles that people didn't fully understand. The more transparency that the alternative asset managers have given about their activities, which came about as a function of their IPOs and participation in public markets, I think the more comfortable regulators have gotten, seeing that this is not some mysterious game. They're investing in real companies, they're investing in real assets. It's a distribution, I believe, like Pierre said, about how companies are participating for longer in private markets because there's all sorts of benefits and the ability to be flexible. And the VCs have raised astronomically large funds to help facilitate that. And entrepreneurs view public markets to have a lot of risk and lacking innovation. And so as that continues to happen and everyone puts their cards on the table, number one, education gets easier, right? Because technology platforms can facilitate, opening the kimono in a data-driven way. And therefore that, again, accrues to the benefit of the end investor.
I heard a term the other day. Someone said, is that an alternative investment? I said, no, it's a traditional alternative. It's not like a crypto thing. So a traditional alternative now is a new category for like private equity and the traditional alternatives.
The stuff
it's
you
not
still
like
need
that
to sign.
blockchain and the new NFTs. Those are alternatives.
Yeah.
So are you, just to follow that thought, Pierre, did you have a comment on that?
Well, I was going to say, what I think is fascinating, though, with back to the regulatory piece of it, right? It's, it's a pendulum, right? It swings back and forth. And so, and I'll get to sort of this equity piece in education, because I actually think there's a little bit of difference there. And what I would have said was, if you think about where institutionally alts have played for a very, very long time, it's basically these pension markets, right? And these high net worth investors. And the pension markets, as many of us know, are not growing quite the same way anymore, right? And they've been smaller and smaller and smaller. And they've been largely replaced by 401k markets. And the 401k marketplace as a whole is not very welcoming to the alts, right? And they're started to have some noise about that, sort of 2020, sort of as the last regime left, new regimes coming in. You're not seeing the same thing from the DOL. But what I would argue is that 401k plans as a whole, and 401k plan participation has done more to educate the American populace of equities and bonds than sort of anything else, right? Obviously, we're all doing this financial literacy. Everyone's trying to do these things, but so many people have learned a lot more about that because, that's how they do it now, right? And that's how you get your retirement and, family dinner, or Thanksgiving dinner. You're all sitting around together and rebalancing your 401k plan. And I would argue,
Is that what you do in your house?
That's what we do in our house, But I would argue that that's where, if you start getting some alternative exposure there, that starts getting a bit more mainstream. I think it's that. I think it's, just the broad education level that, people can provide. And I think we do actually all have some level of fiduciary risk, because I will promise you that should we get into a relatively sustained and persistent down market, especially one where alts are leading it down, the SEC's view is not going to be, oh, everybody knew. It's going to be, what did people do to do this?
Yep.
How did you educate? How did you help?
But let me ask you just a question about Franklin Templeton. It's a household name. We've in the traditional space, but you guys now have really gone on a tear, acquiring alternative investment firms. Can you talk a little bit about that? What's the thought around that? Why are you doing it?
Sure. Well, I think from a simple commercial perspective, if you look at sort of the marketplace today, there's a study we've seen more recently that by 2025, almost half of asset management revenues are going to come from alternatives. That's a big number in and of itself, right? And I think what you're also seeing is intense fee compression across the equity and the fixed income spaces, lack of correlation between a lot of those things. And so if you have an alternative platform that delivers, less correlated and performance, there's an opportunity set there. And so since, even before 2018, we were doing some of it, but 2018 really marked a big turning point. We acquired an amazing private debt manager, Benefit Street Partners, followed quickly by Clarion, which we got in the Legg Mason deal. So we had this big private real estate, and we're working towards closing on a private equity deal with Lexington, which closes in May. And so we went from basically a $0 shop to effectively, our pro forma by 9/30 of this year will be $200 billion and so very, very rapid escalation
200 billion in alternatives.
in alternative AUM.
All through acquisition, of course.
Yes. And sorry, we
Mostly.
do have some organic growth. It's
Mostly,
probably
yeah.
tech, mostly. That's
And
impressive,
what
right?
is the total
And that's,
size of Franklin Templeton now?
we're about 1.5 trillion.
1.5 trillion.
Yeah.
That's a pretty big allocation to alts. And what do you think it'll be in 3 to 5 from now?
On the alt side,
Yeah.
we'd like it to be a lot bigger. We think the marketplace is growing, to your point, very, very quickly. We're looking for a very aggressive raise, both in the retail and the continued alts growth.
Got it. Howard, I've had a front row seat to some pretty remarkable things at Apollo, and just about Apollo here, Mark Rowan's taken the helm recently and has made no secret that wealth management and getting the individual investor exposure by their financial advisor or direct to the consumer is a top priority. You guys are standing at 600 billion or 500 billion. Tell us about how you're thinking about that. You've also made some unique investments.
Yeah, no, look, it's almost a very different situation, right? When Pierre and I were talking about this before, where you all have a tremendous footprint in the world of wealth and are now bringing in the product to really go up market and to round it out. We're in that category that Adam was talking about, like the big alternative asset managers that were kind of shrouded in secrecy for many years, where people were kind of like, you read headlines and you heard about performance, but didn't really understand what was going on. So we grew just by serving the non-wealth advisor and the non-individual investor community almost 40-fold from an AUM perspective in the last 12 years. So there was kind of a bit of a blind spot around what was going on with individual investors and the like. But just following a lot of the dynamics that we talked about here today, pension shrinking, wealth, the wind at our backs in terms of being able to deliver alternative solutions in the right product, frictionless, et cetera, the firm made a strategic decision, and Mark Rowan was at the top of that, to really focus on diversifying our client base, but by doing it in a way that I think is quite interesting, which is we're not changing the product mix, or we're not doing anything different by creating new investment teams that are doing things just for wealth versus those that are doing things for the institutional world, but rather creating structures that go up, down, and sideways across all the different assets or all the different investor types. So look, Mark Rowan's made no secret about it. We have a very, I think, don't tell him I said this, but a very achievable 5-year growth plan in wealth of 50 billion of assets from zero. And we've got a goal of effectively being $1 trillion asset manager inside of 5 years. So it is a focus. All of the regulatory stuff that's coming behind us to help us do that the right way is helping. But we have the product and we have the resources. Now it's going back, kind of bringing it full circle. What keeps me up at night is making sure we do it the right way, because I am scared to death that something gets positioned to a financial advisor and, God forbid, their client the wrong way, even with an incredible investment acumen behind it, because that's what blows it up for all of us. So doing all of that, but doing it the right way and delivering the resources to support it, I think is going to be critically important here.
Absolutely, and there's been a huge amount of advancement in scalable AI-based learning and just to make sure accreditation on the advisor side. Rishi, you kind of come from a slightly different angle. Your company is kind of at the tip of the spear with the pulse of the individual investor, would you say?
Yeah.
And what are some of the insights that you're seeing at your business right now that maybe are surprising you, or the trends that you're picking up on?
Yeah, I mean, I think, going to this alternatives, for a long time, Stocktwits was very much U.S. equities centric. And over the last 5 years, crypto has become a bigger part of the conversation and the platform. And what we're now seeing, the rising interest in, what I'll call retail alternatives. Maybe that's alternatives. I don't know.
It's right next to traditional alternatives.
Right. Yeah. So, somewhere in there. But there is an increased interest amongst that next generation of investors in these other assets that are not 60-40 portfolio. They don't have QSIPs, right? Maybe that's the other way to look at it. And we want to be there to support them. So one of the things we're focused on is actually building out our platform to support these other assets, to provide information, and mostly to allow the community to connect. Because going back to the education piece, especially in the self-directed world and the retail world, I strongly believe investing, even in the institutional side, is an apprenticeship game. It's about learning and having mentors, and your communities and your tribes can facilitate that. And as we see the interest rise amongst our retail kind of user base, we want to be there to help facilitate and connect those individuals with each other, whether it's wanting to learn, hey, how do I participate in this fractionalized private equity firm, that now has liquidity and is available to us via platforms, or if it's, Pokemon cards and whatever, which are all assets that, trade for hundreds of thousands or millions or tens of millions of dollars. We have seen increased interest in that. We are focused on building out solutions for that, whether it's community and education, whether it's the actual partnerships with platforms to execute against that, or whether it's portfolio management tools to understand all these different products that you might have invested in beyond just stocks and crypto.
Absolutely. This concept of taking institutional product and bringing it down within reach to the individual investor, to the financial advisor, is not just limited to alternatives. I think, Adam, what you're doing at YieldX is fascinating, but in many ways, it is optimizing institutional thinking. And if you were here with Catherine Keating this morning, same concept, bring institutional portfolio management down to the individual. But just a word on YieldX before we leave here in the last 2 minutes.
Yeah, absolutely. So we started YieldX to provide not retail investors, to provide RIAs and wealth managers and broker-dealers with the types of tools to create and optimize portfolios of yield-driven securities in the way that large asset managers would have teams of people to be able to do. And the thesis behind it is that people are demanding customization, and they're demanding it in a massive scale that large asset managers don't have the ability or economics to do on a personalized basis. So we created a technology platform that really unites the 4 key pillars: the access to the individual securities. So anything that has a yield, whether it's fixed income or yield-driven equities, we're adding a crypto yield product that we're seeing a lot of institutional demand for. We have over 2 million securities on the platform today. Second layer is an analytics layer. So pulling that all in, running sophisticated analytics that teams of people would have to do it in scale, and then tie that into execution and custody, and then have the ability to use core analytics and core systems beyond that. And so
I think you're representing kind of this next layer of democratization in all different types of products.
Yeah, exactly.
Yeah. Sure. I'll summarize and take just one or two questions. I know we have just a minute or so here. But if you think about really what's going on is that $25 trillion in wealth management, low allocations to alternatives. That means that multiple trillions of dollars over the next couple years, 3 to 5, will move from traditional assets, ETFs and mutual funds, into alternatives, based primarily because the financial advisor wants a way to manage money more effectively. But that is a very big target for Blackstone, for KKR, for Apollo, for Franklin Templeton, who are all going to spend a lot of money to become the next mutual fund brands in the alt space for the wealth market. So when there's that much money at play, just let's all keep an open eye on what's happening in the industry, who's going to capture those trillions and who's going to solidify themselves as, the equivalent of the Fidelity mutual fund or the Vanguard mutual fund in the alt space over the next 3 to 5 years. So really exciting, a lot of forces at work. Let's do it the right way. And you guys all have a huge role in that. So congrats to that. So love to take that question. I have an answer, but I have people on this panel who I'd love to have answer that question.
I'll jump in because Mark Rowan, our CEO, actually talks about this a lot. And what he says is, assets under management is a reward for good performance. It's not the end goal. And so what that means, and I can only speak very much from the seat I sit in and the organization I represent, is that when we're bringing offerings to the high net worth investor via financial advisors, and to your point, going down market in terms of the client base that we hadn't, in terms of the size and the scope, we're doing it pari passu with what we're doing for our institutional investors. So it's not that we're changing, or not that we're creating new vehicles with side pocket investment teams that just manage capital for wealthy individuals versus institutions, but rather taking those same asset classes and leveraging platforms to make them available with, frankly, a similar fee structure in a lot of ways. I mean, it varies across the asset classes, but if you look at private credit as an example, whereas in the old world of private credit for an individual investor, you wanted to go into some vehicle, you might have had a 2, 3, 4, 5% upfront load just to invest and fees that were commensurate year after year. You look at funds in that non-traded space today that are available to wealth individuals, and we have one, but we're not the only one. They're generally around a 1.25% management fees, and carry over a 5% hurdle that's anywhere between 10 and 12.5%, which again is consistent with the same returns that are being charged to institutions in those same vehicles via private vehicles. You're welcome.
Thank you all.